Welcome back to the Investing on the Go podcast brought to you by FundCalibre. This episode takes a look at the world of high yield bonds, examining current trends, risks, and opportunities, including why high yield isn't as risky as commonly perceived.
I'm Josh Murphy, research analyst at FundCalibre. Today, I've been joined by Jack Holmes, manager of the Artemis Global High Yield Fund. Hi, Jack. How are you?
Hi there, Josh. Good. How are you?
Very, very well, thanks. Very well, thanks. First, let's just start with a brief introduction into what high yield is and how we sit today.
Yeah, perfect. Well, look, the high yield market is a part of the bond market, so it's about lending specifically to companies in this case. And the name high yield basically alludes to the fact that we're lending to slightly riskier companies and therefore getting paid more for that. Now, it is a market which has historically had a varied reputation. A lot of people kind of consider them junk bonds and worry about defaults and excesses within the market. I think that's somewhat overplayed. If we look at the market today, it's a very different market to the market it was in the 90s or 2000s. So, for instance, more than half of the market today is double B rated, which is the highest quality part of the high yield market, just below investment grade. And if we look at that through time, over the last 50 years, the average default rate on that part of the market has actually been 0.6%. So a very low default rate. So I think is it a Hardy quote? The rumors of my demise are exaggerated. I think the rumors of risk within high yield are actually exaggerated. So whenever I look at the market today, more than 50% double B, less than 10% triple C, the riskiest part of the market, which is actually where we see the vast bulk of defaults occurring through history. It actually looks very attractive with currently, if I'm talking about for a sterling investor in our fund, a yield of almost 7.5%. That looks like an attractive place to be relative to, again, a relatively low default risk going forward.
And then, Jack, in that case, what area of the market are you currently favouring?
Yeah, so we run a global strategy, so we can theoretically invest anywhere in the world. In reality, high yield is broadly segmented into US, kind of North American high yield, European high yield, which includes the UK, and then emerging market high yield. We focus in our strategy on developed market high yield because we think it actually offers the best risk reward for us and the best expression of our particular strategy. But within that, at the moment, we're focusing more on European and UK credits and bonds. We actually find that market relative to the US looks a lot more attractive in terms of pricing versus the risk that we're taking. So we're currently more focused on Europe. The other area that's worth highlighting is, again, going back to that point about different credit ratings and the level of risk we're taking through those. We're focusing very much on the double B and single B part of the market, the higher quality parts of the high yield market, and avoiding triple Cs at the moment, the lowest quality, highest risk part of the market. Just to put some context on those kind of the different risks between those two areas. Over the last 50 years, if we look at those default numbers, I mentioned the 0.6% annual default chance in double Bs. That figure is 26% in triple Cs. So you're taking 50 times more risk within the triple C part of the market than you are within the double B market. And frankly, we don't see that reflected in pricing today. So we're focusing on higher quality, high yield, lower chance of default. And the final thing I should mention is we are focusing very much at the moment, given the current yield environment, on shorter dated bonds. So bonds maturing in less than, say, 6 years. We think that is a much more attractive part of the market where we're actually able to get some very, very high yields, but without having to take a big bet on actually the direction of yields going forward. And I think that's been certainly the lesson of the last couple of years has been actually taking a pound of yield up front is actually a very valuable thing to do versus trying to make a bet on what it's going to look like in 20 or 30 years time. So broadly, double B, single B, higher quality within the market, more focused on Europe than we are on North America. We're not investing in emerging market high yield, and within the maturity profile, very much focused on the front end in terms of shorter maturity bonds.
And Jack, you said there that there's 50 times more risk in the triple C, and that isn't quite reflected in current prices. Does that mean that the high yield market is inefficient, or can you elaborate on this for me?
Yeah, sure. Yes, the high yield market is inefficient. I'm an active manager. The fund that I run is a very active strategy. We're looking to invest in between 80 to 100 bonds versus 1,600 issuers in the universe, about 3,000 bonds. So we're very much looking for a way of expressing an active view within this market. So kind of by implication, we have to think that the market is inefficient. Certainly, our performance over time would suggest that there's inefficiencies that we can benefit from. I would say the rating part of the spectrum is definitely one of the areas where the market is inefficient. Generally, in good times, triple Cs are, to our mind, overvalued. And in very weak periods of market return, they actually tend to be undervalued. People actually have a kind of fire sale approach to the triple C part of the market. So at the moment, spreads are reasonably tight in terms of the credit spread between government bonds, kind of risk-free rates, and what we get paid for lending to a company. So we're focusing on the higher quality part of the market because, frankly, we don't think we're getting the compensation for reaching into the triple C part of the market. I guess the other point I should mention is we are a global strategy. Now, there are other global strategies in the high yield market, but I think we're reasonably unique in actually looking at things from what we would consider a kind of truly global perspective, in that each of us who work on the fund actually look at bonds from across the spectrum. So US dollar bonds, European bonds, sterling bonds. We look at across the whole gamut of currencies. The majority of high yield investors will focus on a single currency, and that can create some very big pricing discrepancies between even bonds of exactly the same company, exactly the same fundamental risk. You can actually create a lot of value by just looking between those different currencies and picking the most attractive opportunity within that. The final point is really around the dynamic in the market. High yield is a market which is unlike equities, where you kind of have this framework around large cap, mid cap, and small cap, depending on which part of the market you want to look at and which size of company you want to look at. That doesn't really exist in high yield. High yield is just the high yield market. There's no real distinction by that framework. What that does is it actually means that there's a massive amount of analytical attention and capital that goes towards those larger issuers, those larger companies in the high yield index, which we think results in them actually being, to be honest, structurally overpriced versus a lot of those smaller issuers. And I should emphasize here, when I say large and small issuers, I'm not necessarily talking about large and small companies. A lot of those smaller issuers are companies with market caps in the tens of billions, earnings in the billions, but they just don't use the high yield market as a significant part of their funding structure. Actually, if we look at a lot of those larger issuers, frankly, the reason they're large issuers is because they've been burning so much cash through the last 5 or 10 years that they've had to borrow lots of money. To be honest, they're exactly the kind of companies you don't want to lend to within the market. However, the way that the market is structured in terms of people just generally looking at the high yield market as a whole, it means that capital and analysis tends to flow towards those larger issuers because they're the bigger parts of the benchmark that people focus on. So by focusing on the smaller issuers, we think we have a structurally more attractive in terms of yields available, but also a less efficient market for us to find individual opportunities within. And I would say that's been one of the kind of 5+ years that we've been running this strategy. It's been one of the most profitable areas in terms of finding opportunities within that part of the market versus the larger issuers, which frankly everybody owns and everybody knows very well.
Well, that's all very interesting, and it's that strategy certainly makes sense. Jack, unlike with investment grade debt, high yield bonds can be called or redeemed before they mature. Can you explain this for us and give an example of what this means for the bondholder or the fund in this instance?
Yeah, I mean, it's been one of the really interesting things over the last 2 years, actually, and it's something that we've been quite aggressive in terms of exploiting. High yield bonds are very different from investment grade bonds and from government bonds, as you say, because they can be redeemed or called early by the company. So rather than simply waiting for a maturity date, the bonds can basically be paid up in full by the company before that point. Now, you may say, well, what difference does that make, really? Well, what's interesting today is the majority of the market is trading below par, below 100. In effect, if you think about a bond as pricing with, say, £100 of capital behind it, the bonds are trading below £100 in terms of the price that you would pay for that bond. What that means for a high yield company is actually, because these bonds get redeemed early, and if we look over the last 12 months, on average, bonds are being redeemed about a year and a half ahead of maturity. What that means is, effectively, if we buy a bond that's, say, on paper maturing in 3 years' time at a price of, say, 90p in the pound, what actually happens is, in, say, a year and a half's time, if that company comes and redeems that bond early, redeems that bond at a price of 100 or above, then effectively we get a kind of early capital upside in that position. So by focusing on this part of the market and by looking for these opportunities where the market is just mispricing the chances of companies coming back and refinancing these bonds early, it actually has created quite a lot of value for us, where we've had a very strong period for the last 2 years in terms of delivering positive total returns, both in absolute terms and versus the market. But we think we've actually done it with a lot less risk by focusing on higher quality bonds within the shorter dated part of the market. It's just a fundamentally much less volatile part of the market, but also we're able to extract that capital upside from these early calls happening. So we've kind of had the best of both worlds, really, in this kind of strategy. Going forward, that looks like it will continue. It's really a function of the fact that a lot of these bonds were issued before yields across all fixed income markets significantly rose in 2022. So there is a natural kind of process by which those bonds will no longer exist, and therefore we'll have to adapt our process to find different sources of alpha. But for the next year, 2 years, we think this is going to be a very strong contributor to performance going forward, as it has been over the last 2 years.
And maybe kind of looking more broadly, most major economies have started their rate cutting cycle. What does this mean for high yield?
Yeah, I mean, in general, it should be a good thing. We should be seeing interest rates coming down, which should stimulate economic activity, which broadly should be positive for high yield. High yield companies tend to be, more related to the cycle than a lot of other parts of the bond market. The other thing is that because high yield is naturally a shorter dated market than other parts of the bond market, so whereas, say, the average maturity in our fund is about 3.5 years, the average maturity in, say, an investment grade or a government bond fund may be 7, 8, 9 years. So it's a shorter maturity part of the market overall, and that is the area which is being most impacted by those interest rate cuts. And effectively, that should create capital upside for an investor in those shorter dated bonds. So overall, it is positive. I think the other way of looking at it, though, is if we think about this year, it's been a really I think a lot of people came into this year thinking this is a year where central banks are going to start cutting rates, therefore bonds of all stripes are going to do very, very well because yields are going to fall. There's going to be a lot of capital upside for investors. And I think what's been interesting is it has been a good year for certain parts of the bond market. So, for instance, our strategy has delivered a return of almost 11%, a very strong return for investors. But if you think about it, the most obvious place, if you thought, okay, say the Federal Reserve in the US are going to start cutting interest rates, what's the most obvious way that I can make money out of that? I'll go and buy US treasuries, so US government bonds, the ones that are most correlated to the Federal Reserve cutting cycle. The US Treasury ETF, so the ETF that's reflecting that part of the market, has delivered a return of 1.4% year to date. So less than half of what you would have got from just putting that money in a savings account. So it isn't that it's been a bad year for bonds. Certain parts of the market have done very well, like high yields. But actually, the obvious elements that you could have looked at and said, well, okay, we're going into a cutting cycle, therefore government bonds are going to do very well. Actually, it hasn't played out that way. So I think it has kind of highlighted that actually we are in a different cycle this time round. And actually, sometimes going back to that point I was making earlier about having the pound of yield up front rather than making a bet on what happens in terms of what's called longer duration assets, assets that have longer maturities and are more sensitive to interest rates moving up or down. Actually, it's been a better environment to focus on, if you like, the bird in the hand rather than the two in the bush.
And then maybe going forward to next year, is your view an optimistic one? What's your outlook for the high yield sectors?
I mean, overall, I'm optimistic. I think it's a good market for high yield. I think we're starting with, I think I mentioned it earlier, but a yield on the fund of 7.5%, almost 7.5% for a sterling investor. That to me looks like a very attractive level of return, especially considering the fact that, as I mentioned, both in terms of the market and in terms of our positioning within the market, we are relatively conservatively positioned. So I'm pretty positive in terms of total returns for investors. If you look at history, the best guide to what returns look like has been the starting yield. On average, that's the outcome that people receive. So kind of high single digit returns for an asset class that exhibits a fraction of the volatility of equity markets, say, looks like a pretty good deal for me. I think it is important, though, to really emphasize the difference between a passive and an active approach, though. If I look at the market today, it's a market which has some unusual characteristics to it. So normally, if I was worried about the market or I was trying to position conservatively within the market, I would sell cyclical companies and I would buy non-cyclical companies. So I'd sell, construction firms. I'd sell industrial production companies, things like that. And I'd buy maybe telecommunications or healthcare bonds instead. I think this is actually a very, very different environment because I think the risks actually within high yield are more focused on the non-cyclical part of the market, because we have to remember there's two parts of the equation. There's the volatility of the underlying business, but then there's also the capital structure that's being applied to it. And what we've seen over the last decade has been a lot of those non-cyclical businesses, because they were seen as such a safe haven, have actually had huge amounts of debt put on them, given by high yield investors. And a lot of those larger issuers I was referring to earlier that we're avoiding are actually in those sectors, telecommunications, healthcare, where they've been able to borrow huge amounts of money because, frankly, investors looked at them as very, very low risk. I don't have to worry about people not paying their medical bills or paying their phone bills. And that's fine. But what we're actually seeing is a lot of those business models are actually being structurally challenged. If I look at things like cable TV, frankly, does not have the same ability to charge customers what it does, what it did 10 years ago, given we now have Netflix and Amazon Prime and all of those other over-the-top services. So there's a change in the business model of a lot of these, but also, frankly, these are the big balance sheets where that change in yield environment that we saw from 2022 onwards means that the cost of funding those balance sheets, those big balance sheets, has more than doubled for a lot of these companies. And frankly, they're not built to sustain those levels of interest cost. So I think we're in a very interesting dynamic today where actually those non-cyclicals actually look like the most risky part of the market. On the other side, if you're a cyclical business within high yield and you've been around for the last 5 years, which the majority have, we haven't really had a lot of new issuance in high yield. So it's basically the same cohort of companies we were looking at 5 years ago. If you're a cyclical business, you've survived COVID, where probably your revenues basically went to zero for 3 to 6 months. You then survived the inflation spike and the supply chain issues of 2021 and 2022. And then from 2022 onwards, you've basically had your interest cost double or triple. If you are sitting here today and you look reasonably well positioned with a reasonably resilient balance sheet today, I would argue for a cyclical business, you've had basically all the stresses you could have put upon you over the last few years. And that to me makes me quite bullish, because a lot of people are still regarding those businesses as very, very risky businesses. And therefore, they're expecting very high yields to lend to them. I think that looks like a much more attractive place to earn your yield in high yield, rather than, frankly, lending to a non-cyclical business that, while on paper it may look like a good risk reward, is actually carrying a lot more structural problems with it than perhaps investors are appreciating. Yeah.
Jack, thank you very much for your time today.
Thank you very much.
This is a high conviction fixed income portfolio of high yield issuers across the globe. The managers look to increase the value of shareholder investments through a combination of both income and capital growth. We like the unique approach behind this fund, with the managers taking advantage of the inefficiencies created by many of their peers, focusing heavily on the larger players in the index. To learn more about the Artemis Global High Yield Bond Fund, please visit FundCalibre.com. And whilst you're there, don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.